I'm Charlotte McLeod with investingnews.com, and here today with me is David Morgan, publisher of the Morgan Report. Thank you so much for being here. Always great to catch up with you.
It's been a while. It's good to be back. Thank you.
It has been a little while. We're catching up from our last interview quite some time ago. So I wanted to start by at least spending some time on getting your thoughts on gold and silver in the first half of 2026. I'm sure everybody will remember the big runs up very early in the year. Now we're in a pullback. What is your thoughts on that? Where would you place us in the cycle at the moment?
Oh, okay. Well, you asked me about three. Let me unpack a couple of them. First of all, last time we spoke was in October 2025. We broke through 50, and then, as we all know, went to like 120 in January. But you asked me what's happened since then. So I think one of the main questions is silver, has the bottom been reached? And the market appears to have established an important floor near the $50 level, but I wouldn't declare the correction completely done yet. My working range remains between the low 50s all the way up to 90. And until the market demonstrates that it can hold above the upper end, which would be above 90, we haven't really reestablished the bull market per se. The recent recovery in the mid 60s is very constructive, but silver needs to remain in that range and higher, not merely a short covering rally, which is taken it to that level currently. So I'm more concerned about how many weeks of activity we stay above, say, 60 than any other technical indicators. So I think you could state that silver is a very small market with a very large monetary story attached to it, and that guarantees further volatility. It's the swings at the monetary demand that moves the silver price up and down. The industrial demand is key. It's over 60% of the market. But it's pretty steady Eddie, meaning in a bad year, it's off 1% or 1.5%, which 1% of a, $60 billion market is still a big number, but 1% is only 1%. So as the $100 blow off top, that's another question. And I would distinguish between a cyclical peak and the completion of a larger bull market. I don't think it is the peak. Undoubtedly, silver became overheated and ran too far too quickly. But I want to remind everyone, Charlotte, that the last time we interviewed in October last year, silver is up 70% as we speak, or no, it wouldn't be a 50. Sorry. It's up substantially from the last time we spoke. And I think that's key because, a lot of people look at it as having missed the top, and yeah. I mean, if you didn't get out above, 90, you missed that top. But I think the leverage momentum trading and speculative enthusiasm was amplified, and that caused the advance. And this correction removes that excess speculation, but it didn't eliminate the underlying monetary and industrial case. So those are still intact. The true secular top would normally include a much broader public participation, persistent shortages, and widespread media excitement and speculative excess into the mining shares. We didn't see that. The last one I would add is usually when you get a top in the metals, you're getting, I wouldn't say necessarily a bottom in the stock market, but you're getting an inverse in the stock market. In other words, people that were in love with the stock market for the last 20 plus years start to sell off, get out, exit, take profits, buy puts. In other words, gold and silver, especially gold, are most negatively correlated to the stock market in the long term. There's times when they trend together, but not for long. So the move to 100 is probably a speculative peak, not the ultimate peak.
This is great context on where we're at right now for silver. And of course, we want to talk more about what's to come. But because we haven't spoken since silver got to that triple digit level, I want to take a moment to ask what your strategy was during that time. Were you taking profits, or how did you handle that?
Wow, that is a great question. And thanks for asking. I'm going to, if I can find it, I don't want to. I just got an email from one of my members, and I'm not seeing it here, but I anticipated to move to 100. First of all, I did what I said I would do. I told all of my members that I would throw a party when, I didn't say if, when silver hits $100 the ounce. The problem with that commitment, Charlotte, is that I had to get the venue, put down the deposit, coordinate where, when, all that, a couple months in advance. And silver had not hit the $100 level yet. Yet I still had to send in the funds and make the arrangements and all that stuff, which I did. And of course, then it begs the question, well, if we didn't hit 100, David, what would you do? And the answer would be, I would stand up and take it like a man and say, look, we got to 85 and we got 85% there. And the reason why, is as follows, but it did. So there's that. But I had, to your question directly, anticipated this blow off move. I put a PDF file together for my paid members, and I urged them to take partial profits on the way up, selling into strength. And many did. And many that did came to the party. And some showed me what they'd done with the proceeds or told me what they were going to do with the proceeds or whatever. And it was very exciting for everybody. But I suggested starting to take profits at the $80 level. And I'd have to look at my own PDF. It was 80, 90, 100, or 80, 100, 120. But it was spaced out like, sell 20% when it hits this level. It goes higher, sell more. If it goes higher, sell more. And some sold it all. I mean, it was guidelines. It's not, it has to be 20%, but at least take something off the table. So that's how I approached it. I also approached it on the gold silver ratio because many of my clients are, not my age, but they're 50 or older. Some are younger. I've got them all over the map, but the majority are probably mid 40s or older. And they want to swap silver to gold at the proper ratio. So I also did a PDF file on that and published it at the same time for my members. I said at 50-1, swap some, not all, but take partial, moves from silver into gold. And it did hit that. And that's the best it did, is in that range. The idea was the same, 20% swap at 50, 20% at 40, 20% at 30. And if you really want all gold, if it gets below 30, swap the rest out, kind of thing. So thanks for asking. I just got a nice letter. I can't find it. But basically the gentleman said, thank you for, providing this information to me. I did well. I'm financially independent now. Your guidance was invaluable. I don't want to embellish it, but it always makes you feel good because, as we get beat up, especially when, you make a bad call and, sometimes I made a bad call, but I've adjusted it for my readers, but people that hear you and only know me from your channel. I mean, there's people who don't know I have my own channel or whatever. And well, David said blah, 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 blah to Charlotte. And it's true. I can't take it back, but they don't know that I changed my opinion or data showed otherwise later on and I made good on it. Not that I'm perfect, not that I haven't made errors, but, unless you follow my work, let's say, from, not say daily, but as I publish, let's say, you don't really know what I'm doing. You can criticize me for things gone by and that's okay. But until you're running the race with me, you really don't know what I'm doing. I hope I don't sound like I'm trying to be defensive, but, I do my best and it isn't perfect, but I'm not far off the mark most of the time.
That makes sense to me. And thank you for sharing the strategy as well. I think it's great to go into. Based on your initial comments, I think that it's clear that the case for gold as well as silver remains strong into the future. But I wonder if you can talk about the factors that were weighing on the metals in the first half of the year. I think we know that not everything can go up forever, so that's part of it. But what else were you seeing during those months?
Yeah, that's a good one. What was holding gold back in the first of the year? I think one, normal cycles, and normal cycles means, as I've already explained, way too much enthusiasm. I mean, markets go from undervalued to fair value to overvalued. And even though I think gold and silver are undervalued and probably were undervalued at their peak, doesn't mean they weren't overbought. There's a difference between being undervalued or overbought. And the futures markets control the price of gold and silver, as we all know. And those are speculative casinos most of the time, especially in a frothy market. So I want to make that distinction. I think that's very clear. But gold was held back primarily due to that advance. The other principal headwinds were higher bond yields. That aggravated the energy and the sector, and of course the war started in, I guess, late February. A stronger dollar does affect the precious metals. Weaker ETF demand, it blew off that top, and then some withdrew and took their profits and left. Profit taking on a technical basis. Reduced expectations for rapid Fed easing also added to it. And it's a competition from stocks and cash. When the stock market continues to make new highs and people are already in the stock market maybe haven't allocated to the metals at all or have a minimum allocation and watch it go up and down, they get scared out. They don't want to reallocate or rebalance. So I would say those are about the four main reasons.
Again, really good context on what's happening with the metals. And I want to hone in now a little bit on current events. So we've had a bit of a tough summer, but in the last couple of weeks or so, we've seen gold and silver start to rise again. So I wonder if you can explain what's happening. I think it's encouraged investors, but people are also wondering, all right, is this real, or could we go back down once again?
Well, as I said earlier, I do think we could go back down once again. In fact, it wouldn't surprise me to see what I call spike low. Like, it's like a parabola going upside down. It's obviously it's a big drop. It could be called a waterfall decline. I like to call it spike down. But so I think we could see this $60 level, 65 where we're at today as we're doing the interview, and move along there for weeks. And then all of a sudden something comes out of the news or an event at a depository or something that moves the market rapidly down for a matter of hours, a day or two, doubtful a week. The spikes are called spikes for a reason. They're very quick, very sharp, substantial, scary, especially if you're on leverage, but they don't last long. So I don't rule that out. The current events, cooling inflation and weaker employment. The July CPI showed 3.4%, while core inflation declined to 2.5%. This, combined with recent weak employment reports, has reduced expectations for another imminent Federal Reserve rate increase. The Strait of Hormuz and Iran, of course, are key. Escalation creates safe haven demand for gold. Higher oil prices create additional inflation, and additional inflation can keep interest rates elevated. So elevated rates and a stronger dollar tend to restrain the gold market. Silver can initially benefit as a precious metal, but suffer if expensive energy threatens industrial activity. So you got those two negatives based on what's happening in the Strait of Hormuz and this war with Iran. Oil approaching $90, which we've seen. Monetary inflation and reason to buy gold are for that. But a reason for the Fed to maintain higher rates are because of that pressure. So again, there's kind of both sides of the coin. And renewed Western ETF buying. Global ETFs attract approximately $3 billion in July, reversing 2 months of outflows. Holdings increased by 23 tons to 4,000 plus tons. Europe led the buying, while North America participation was rather modest, according to the World Gold Council. So central banks have supported the gold market for years, as we know, and the next major leg may require Western institutional investors to return, and they have not.
Part of the reason I asked that question about whether we can go lower is over the summer, I've been seeing a lot of questions about when to re-enter the market. I think people are really trying to figure out when the bust point could be to re-enter after likely taking profits at those higher prices. So how do you look at that? We talked about this strategy for what to do on the upside. How can people handle it when we get to these lower levels and they want to get back in?
Well, two things. One, for my private, paid people, I tell them when I'm buying. That gives them some confidence. But hey, I bought silver at 30 plus at one time, and thinking at 30 it held for almost a year or a little more. And I thought, okay, I'm safe, adding on the way up. And then I was wrong, and I made the call that I was wrong and said it was going lower. So excuse me as I digress. I did this very similar thing, and I learned it from Jim Dines. And I think, I know you're old enough to remember Jim. You were quite young, but so Jim did buying zones, and I thought that was smart because, oh, this is the bottom. No, it's bottoming here. I'm safe. So I put out for my readers that buying silver under 60 was the beginning of the buying zone. Buying gold under 4,000 was the beginning of the buying zone. And as you know, both metals hit those levels, but not for very long. I added to my silver at below 60. It might have been a touch above us, right in that range. And then I added to my platinum position, which I don't encourage everyone to. There's a big spread on platinum, just like there are gold and silver at the retail market right now. But I had a good base at around 1,000. And once it got to the 1,600-ish level, I said, that's close enough. I think that's fair. And I bought around the $1,600 level. And today, I think we're like $1,750 already. Not that every trade I make, and I wouldn't call this a trade. This is to my core position, but a buying zone and a selling zone. And that's what I was doing on the way up. Here's a selling zone. Don't expect to get the top tick. I mean, that's an amateur's game. And I used to play it. I mean, I started investing in stocks at 16. And I thought, oh, I'll buy it here, the exact low that one day hit that price. And I'll sell it here, the exact price it hit for 2 hours during the day. It doesn't work that way.
Yeah, I think so. It works on both the upside and the downside there. I think that makes a lot of sense. I also wanted to mention the gold and silver mining stocks. I think people are also wondering, is now a good entry point there? And where does it make sense to focus right now? I think for me, a recurring theme that I've been hearing is that the metals prices are so high that it might make sense to hone in on those producers versus going further down the food chain. So curious to know your thoughts.
Well, kudos to Charlotte McLeod and INN. I mean, my work primarily revolves around, analysis of the precious metals and the entire resource sector. I mean, we still have uranium stocks we're holding and, some other copper situations and that stuff like that. So gold and silver stocks are where you should put new money. They have broken out substantial. In fact, they've broken out in such a strong manner that they've gapped up on the charts when you're looking at the the HUI or the XAU. And this means that there's a lot of power, a lot of buying power. So I would be encouraged, and the reason I digressed a bit is I'm selling my own book. I mean, I always have told people to buy the real metal first, and I'm not a bullion dealer. I don't make money selling gold and silver. The way I make a living is by looking at the underlying equities. But having said that, and not trying to sound like I'm selling my own book, that is where the value is. And the reason I think these stocks are starting to move faster than the metals and had a big move and gapped up, as I just said, is because the market is starting to recognize real value in this sector, and that is in the equities. And I think institutional money is coming in subtly, but subtly for the amount of money sloshing around the financial system is humongous relative to the amount of gold, substantial gold and silver companies that are producers. So it's, big fish moving in a very small pond. So those type of entities have to be a little bit careful of how much they put in at any one time because it will move the market. So I really believe that's what's happening. The other thing about the equity side that I haven't talked about in a while, and that's ease of entry and ease of exit. I mean, in the U.S., the capital gains tax on a stock is different than the gains tax on physical metal. It's superior tax-wise on the equity side, and there's not the slippage that you get. If you're trading in Newmont Mining, you're going to get in. You're not going to get. You're going to hit the bid. You're going to, buy the ask, whatever it is. In other words, you don't have this big in and out that's appeared recently in the metals themselves, where someone says, "Oh, you can buy silver at spot." But that same exact bullion dealer is buying it back from you at $9 under spot. Well, what good is that? I mean, anyway, in the equities, you don't have that problem. I mean, in the penny stock world, yeah, it can move around like that in the penny stocks. So that's why you use limit orders. In fact, we have a whole section on buying green on the pinks. David Smith wrote it. I'm sure you remember David. And it was all about how smart techniques to use when you're buying these juniors, because just your entry and exit can make a big difference of how much you actually gain by knowing what kind of market orders to use.
Very helpful. And I wonder if you can say more about the institutional interest in the silver and gold mining stocks. I think that's really interesting to look at. You mentioned earlier, we had this big surge in interest when prices were way up at the beginning of the year, but interesting to hear that the institutional interest has remained even as the prices go lower. So anything further you'd add there?
Yeah, I will. First of all, as a blanket statement, it's important to know, someone who's been around as long as myself, is that the institutional participation in the mining sector is lower than it would have been the last bull market in the late 70s and 1980s. And the reason for that is the ETFs. Many were asking for the ability to trade a commodity through the stock market. And when you buy an ETF, you're buying a stock. Yes, it's represented by metal in a vault. I understand that. Everyone does. But you really participate in a stock, and that's why the ETFs come about. So institutional money has returned to the mining shares, but remains concentrated primarily in large liquid producers, as you would expect. Evidence of institutions are returning as the gold miner ETFs received approximately 3.6 billion in January, the biggest monthly inflows since at least 2009. We already talked about that, and I cited that from Reuters. Institutions are being attracted by sharply expanding operating margins. So even though we got this big move to $5,500 gold and $120 silver, sure, the institutions care about that. But what they care more about is what I said about how I'm looking at the charts: sustainability. Now, when they have sustainability, the institutions say, okay, this yield, this free cash flow on this mine is going to continue. We have faith in it. Now we're going to invest. In other words, it's a show me, don't tell me. Many of them held back because they just didn't believe it was more than a quick rally. Now that it's been determined that it's more than a quick rally, it had, again, overbought, but now it's maintaining. They're able to come in because they have such strong balance sheets. They've reduced their debt, dividends and share repurchases by these companies, scarcity of large, substantial, cash-rich, unhedged or lightly hedged mining companies with long life deposits. They're rare, but they're coming into them. And mine equity valuations remain very reasonable compared to almost any other sector in the market. Newmont and Barrick were expected to generate about $3.5 billion in combined second quarter profit, and analysts have anticipated substantial buybacks by both Newmont, Barrick, Agnico Eagle, Kinross. So that's the value. Those are the safe bets. I've taught from the beginning of the Morgan Report, big money goes into big companies. We're not trying to buy every junior that's going to go up 10 or 20 fold. Yes, we have speculations in the account, but my approach is bet money can afford to lose on those. If something substantially happens in the junior sector, like a big discovery, which we're all hoping for, then you have to reevaluate at that time, on the minute, that day, or within a couple days. And then what you determine is how big is the deposit, what's true and what's not true. And then you can do a price based on how many shares are outstanding relative to the discovery. And one of my compadres who left the business, he did so well on it, did it on that discovery by Dr. Barron, a friend of mine, in, I think it was Ecuador. And the market moved substantially, but it was so low compared to the value of the deposit. He loaded up because he understood it. And that's the approach I take. Now, I will admit that my hand on the juniors was very hot 20 years ago. It has not been that good of late, meaning the last 5-10 years. But if you obey the rules of money you can afford to lose, you haven't lost much. It's the problem is the story's great, the management's fair, they're honest. Maybe they're debt free, but they just don't go anywhere. So as you know, since you work a lot in the junior sector, it can be frustrating at times.
Great to get your thoughts there as well. And I want to return to the point you made about the Iran war. You mentioned this is important for us to be watching when it comes to precious metals. And it's an event that it's faded. I mean, it's still in the headlines, but in this sector, I'm seeing less emphasis on it as time goes by, which tends to happen. But can you talk a little bit about why we shouldn't let that fade from our minds and what the impact could be moving forward? Key points you're watching.
Yeah, well, if you're reading my mind, I mean, I wrote the last editorial and it was all about the oil market. And I consider myself average or above average in the energy sector. I don't consider myself an expert at all. And people that want energy exposure, which we've emphasized for at least 6, 8 months, I've just steered them to, in fact, someone you helped me find. You may recall that conversation we had offline. Anyway, energy is the most important commodity. It's far more important than gold and silver are. And in the editorial, I said how important it is. I also said that the chances are fairly high that there will be a disruption in the market significant enough to cause an increase in the oil sector, in the oil price. And it will, of course, affect everything. It affects the transportation cost of products coming across by rail or ship or airplane or truck. And so that's very basic. It's common sense, but something that's you indicated, and I agree with you, it's kind of been ho-hummed at this point. Ho-hum, well, we've heard it. Boy who cried wolf. Oh, I've heard it so many times, I'm going to ignore it now. I don't think you should ignore it. On the other hand, and I hate to talk out of both sides of my mouth, but there is a lot of oil stored in Iran. And if things open up, there'll be, let's say, an excess supply that they might be willing to sell at a discount just to get, some of it all out of their containment facilities just to drain them down a little bit so they can put more supply in. So it does cope both ways. I don't want to talk out of both sides of my mouth. It's very perplexing. I favor what I said, that there's more risk of it going higher than there is of it going lower. But there's other analysts out there that I listen to that make a strong case that no, the oil situation is not as bad as we're being told. I don't agree with that, but time will tell.
Can you talk a little bit more about how you've been approaching the energy market in this context? Definitely, we've seen it really be highlighted. We've seen higher oil prices, but also so much volatility. So I think the interest from investors is there, but maybe it is very tricky to approach right now. So what are you doing at the moment?
Me personally, I'm holding what I bought. I'm not trying to get cute. I'm just letting it ride. I look at it as a core position, and I'm just taking all the ups and downs because I think longer term they're going to pay off. I think we're going to see above $100 a barrel oil at some point. I'm not real big on the shale industry. It's helped a great deal. There's no reason to state otherwise, but it's a very tricky market as far as life of an oil well. It's like 2.5 years or so. So it's the Red Queen syndrome where the queen has to run faster and faster just to stay in place. That's a really accurate metaphor for the fracking industry. So once that peaks, and I believe it has, we may not see the amount of oil coming out of the United States that we've seen previously. Now that's a long-term perspective, but that's kind of how I view the markets from what is the fundamental facts going forward for the next decade. What does that mean? That's why I came up with the $100 silver back in 2005. I didn't say I was hitting $100, next year, 2006, but I said within my lifetime it would, and it has. Point being, Charlotte, that with it right now and the volatility increases like this, it hits 90 and it moves way down, and you get contravening forces and analysis that kind of cancel each other. I think keeping a core position is important, but I don't feel like adding, and I don't feel like playing the volatility. It's too tough.
Again, that makes a lot of sense. You've spoken in our conversations and, of course, elsewhere frequently in the past about the outlook for the US dollar. And one point I wanted to bring up, so since we've had the Iran war, it's actually helped to strengthen the dollar. So I wanted to get your thoughts on that and what it means for the longer term outlook for the dollar.
Yeah, that's a good one. Well, first of all, I'm not in the camp that the dollar's going to zero or it's going to go into hyperinflation. I'm not really aligned totally with the dollar milkshake theory, but these debts do in most cases have to be paid back in dollars. But that's been mitigated by the BRICS, and the dollar's use on a global basis 20 years ago was about 78%. And right now it's about 58%. So when the BRICS came in and decided to initiate and revivify year over year now, that, the real can trade for the ruble can trade for the yuan can trade for the peso or whatever it be, and exchanging currency to currency without going to the dollar, with circumventing the dollar altogether, it's definitely weakened the dollar's status. Not that it's still not the number one currency, but it's not as powerful at 58% of world trade as it was at 78%. So the near-term outlook to me is the dollar is currently around 100% of its value basis the DXY, the dollar index. The dollar could move higher if oil inflation keeps elevated, the Federal Reserve raises rates or stays hawkish. That could add strength to the dollar. The U.S. economy outperforms Europe and Japan, which that seems likely, which would add power to the dollar. Geopolitical stress creates safe haven status. Remember, when we got that sell-off in the metals, the big players, the big money, the huge institutions, the money center banks, they moved into the bond market. I mean, that's the biggest market on the planet. That's the one that's the most scary to me. But nonetheless, that's their safe harbor, their safe haven. So you can see money come out of gold, which is a relatively small market compared to the bond market. Investors unwind the leverage position and seek cash. That will move the dollar higher. And the yen resumes falling despite intervention by the United States. If that happens, you're going to see a stronger dollar.
Just a quick follow up there on the bond market. You mentioned that's the one that is really scary for you. Can you go into why that is? Because I think it's something that people have been hearing more about as the year continues.
Well, I think there's two words. One is debasement. I mean, I used that word probably one of the first lectures I ever gave at, VRIC or somewhere else, that, the dollar is being depreciated on purpose, really, from a debt-based monetary system, the way it's set up. The bankers really don't have they have some control. I don't want to say they don't have control, but the way the system is set up, whether they expand the money supply or wish not to, the overall mechanics are that you're continuing to expand the money supply. It might ebb and flow at times, but overall, to pay the interest on the debt you just created, you have to create more of a monetary base, which means you're continuing over time to expand the money supply, which means over time you can continue to debase the currency. And that means that a dollar, whether it's a currency, which is due today, a T-bill, which is a few months, a T-note, which is a few years, or T-bond, which is several years, those are related to the strength of the dollar itself. And the reason you get a yield is to get a payment, interest, for holding that for a certain duration. But when you're holding that and you're losing money at the same time, in other words, the purchasing power when you cash in your bond is not commensurate with the amount of money you gave to purchase the bond, which is a fact, there's less interest in buying them. Yet, if you don't buy them, the whole system stops. Now, that's an extreme. It's not going to happen, but that's true. Let's say, for example, that as a thought experiment, the bond market just went for their newest auction and no one bought it. I mean, what would happen, and has happened in real terms, is that it gets bid up. In other words, I don't want to buy it at this price. I'll buy it at this price if you give me, which means a higher yield or interest rates going higher, which is the stress on the market right now. And we're seeing that with the 10-year, which is kind of the stalwart. So not to be long-winded, but that's the main place to watch. And so the second word is trust or confidence. The whole system is based on a confidence model that a dollar today is going to be worth something that's similar to what it is tomorrow. In other words, the dollar isn't going to lose so much value that I'm stupid to hold it. So therefore, if I get a little bit better yield, I'm going to hold on to it. And if that confidence is lost, then we have real problems. And the confidence is not lost, but it has degraded, especially on a nation state basis. You look at what China's done with their treasury holdings. You look what we did to Russia with their treasury holdings. You look at what Japan's doing now with the yen problems that they have. And it's a mess. And unfortunately, it could get fairly ugly. I don't expect a catastrophe. I'm not a big doomer, but I am a student of monetary history. And this is the biggest debt-based monetary system in the history of the world. And it will need to be corrected. And I'm not sure exactly how that will take place. I'm not sure that the banking elites know exactly how it will take place.
Well, I was going to ask, and not to go in a doom direction, but you mentioned we're essentially teetering on the edge there of that trust. Is there an event or a catalyst that you think could push us over, or how do you see it?
Yeah, there is. I've said this in previous interviews. I mean, it could be something along the lines of the movie Rollover, which is in 1980. So I'm really dating myself now. What would that be? 46 years ago or something? But it was basically a settlement problem with the U.S. dollar, and the Arabs had problems in the oil market and started to withdraw substantial amounts. And so my thesis is that we could see too much money moving one way or the other, betting on higher interest rates or betting on lower interest rates. And that movement unsettled another big trading house. And I said, wait a minute, what's Japan doing? I don't understand why they're doing it. Nothing. I don't see anything on my Bloomberg. I haven't heard anything on the news. We get the best news. But boy, that scares me. We better participate in it as well. So they move money in the same direction. And after that, then the third big trading house does the same thing. So you could get what's called a contagion or a cascade effect, like the spike low, where there's a huge amount of selling all at once, or buying for that matter, and all of a sudden move the market further than it would have on a normal day. And really nothing offset it more than maybe a little bit of an abnormal activity that caused, I'll say, fear in the market. Now, that's highly unlikely, especially with the circuit breakers that are intact, the Working Group on Financial Markets, better known as the Plunge Protection Team, because it's something like that. If it were to occur, there are mandates in place that would stop the trading. But even with stopping the trading, as we saw after 1987, and it was enacted in 1987 when they decided to do this type of intervention if necessary, doesn't necessarily mean it would stop it altogether. I mean, you could close down the market for 2 hours, let it cool off, reopen it, and it starts to plunge again. Again, I'm not forecasting that, but we do have to be aware of the reality of the situation. And that's why I've been such a metal's head for so long, because it's sovereign wealth for you alone or your family or your business or whatever. And it has no counterparty risk whatsoever. And that's a unique position to be in the financial industry, because almost anything else has counterparty risk.
I do recall this scenario, but I think it's really good to go over for people who haven't heard it before. As we're coming to the end, I know when we talk, we tend to focus on silver as well as gold, today a little bit of energy, but as you mentioned earlier, you do focus on the broader commodities space. So I wonder right now, what other areas of opportunity do you find interesting? Are you looking at?
Yeah, well, first of all, uranium, I think, is probably due for a rally here. We hold a couple uranium positions. Copper has been the strongest of the metals, or the base metals. I think there's been years of underinvestment in the sector. I mean, think of how many new mines have come about recently. Not very many. Even the energy sector, I mean, the refinery base in the United States is like 50 years old. Now the government's a kind of, the U.S. government, let me be specific, has basically woken up from a very deep sleep and all of a sudden put certain minerals on the critical minerals list and started to mandate certain ideas to get the sector moving, where we're going to produce these type of critical minerals in-house, meaning within the United States. There's huge supply chain dislocations. The West is attempting to rebuild it, but it's going to take time. So this provides an inflationary environment, because if you need it now and you can't produce it here, you're going to have to bid up the price until the seller says, okay, we'll take that amount of US dollars for this commodity. Defense spending continues, rearmament. Unfortunately, it seems like that's going to continue. That puts a big move into energy, copper, silver, aluminum, steel, and specialty metals like rare earths. Monetary debasement persists. High replacement cost. If you look at what it costs to build a F-22, F-35 or whatever, based on not labor costs as much as the amount of materials required, those have, not every one of them, but most have gone up. The ones I'd emphasize are obviously the precious metals and copper, uranium, as I just said, oil. Platinum is still attractive to me. And of course, the agricultural commodities are very good. I don't work in that area anymore. I mean, I look at it occasionally, but there are ways to play it conservatively. There are ETFs. Well, first of all, you can do a commodity ETF. So that just is a basket of energy, metals, and ag all together. So you're just making a bet on the sector, which is a pretty safe bet. Or there are specifics for, precious metals, and there's even leveraged ones, which I would not participate in. The major caution, I think, though, that a favorable secular outlook doesn't mean commodities use will continue to go higher and higher. Recession, which is likely, or a liquidity event, could temporarily pressure the sector to the downside. I think copper is somewhat vulnerable where it's sitting right now, and oil, as we discussed earlier.
Well, I think that's a great list of commodities for investors to potentially take a look at. Any final thoughts before I let you go? Things that you'll be thinking about as we head into the second half of the year?
I'm thinking, longer term. I want to see again what we've already discussed. What do gold and silver do for the next few months? What does the chart look like? What kind of strength do they have? Do they get hit with a spike low or not? And I'm really interested to see what the final prints are at the end of the year. I'm looking for, $78, $80 silver. I'm looking for somewhere close to the $5,000 gold, which is much more conservative than many of my peer group. I still think we have time. We need time to work off the overbought conditions we saw earlier in the year at the very beginning. And once that's established, we got to get into the $5,000 gold and, move back toward the triple-digit silver. If we do it in a more lengthy way, not a spike, but continue to grind higher and higher, ups and downs, but the overall trend grinds higher, I think we'll have a lot more stability and we're able to move to new highs on that basis. If we get into another speculative frenzy and hit another high, for example, and hit over 100 silver and it pops right back down again, that would not be good for the market. That would indicate that most people then would consider, if it ever happens this next time, I'm out because it can't go higher. Exactly what took place with $50 silver for so many decades. I don't expect that. I think we'll see it grinding higher. That's why I'd actually be happier to see gold at, under 5,000, silver in the $80 level by the end of the year, grinding its way up, than to see it really start to catch fire and move. That, I think, would not be overall good for the market on a longer term basis.
Well, let's hope for that slow and steady scenario for silver and gold. Thank you so much for coming on to go over what's happening in the markets. As always, this was really valuable.
My pleasure, Charlotte. Thank you.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is David Morgan with the Morgan Report. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.